สวัสดีครับท่านผู้ชมครับขอต้อนรับเข้าสู่เบรกที่2ของรายการรวยหุ้นนะครับช่วงนี้อยู่กับผมพัชรบรรยายงและทีมงานรวยหุ้นกันอีกครั้งหนึ่งกับช่วงพิเศษนะครับคุยกับโปรโดยAberdeenนะครับกับทางด้านบลจAberdeenซึ่งวันนี้แขกรับเชิญของเรานะครับจะมาพูดภาษาอังกฤษกันเลยนะฮะเป็นผู้ช่วยผู้จัดการกองทุนของบลจAberdeenนะครับคุณทิโมธีครับสวัสดีครับคุณทิโมธีครับ Thank you for joining us today. Let's talk about the new fund that's issued by Aberdeen. What's the full name again?
The Aberdeen American Growth Smaller Companies Fund.
Okay. What exactly are we investing into?
You're investing into a concentrated 40 to 60 name, it's currently 46 names, right. Concentrated, low turnover core portfolio of American smaller companies.
Okay.
And by smaller companies, we mean generally $5 billion USD market cap and below.
Wow, that's small already.
yeah, it is fairly small, but we feel there's exciting opportunities in US small cap companies, and we really want this to be a small cap portfolio for investors. That's why we like to keep it below $5 billion USD market cap.
Right. For the last quarter of investment, for the last quarter of the year, why are we concentrating on the just small cap? Why not the large cap?
Well, I think both asset classes have advantages, but what we like about small cap in the near term, three things. One, the macroeconomic environment is supportive. Right. Two, the corporate fundamentals are sound. And three, the valuations are reasonable. So let's go through each of those.
Sure.
Number one, in terms of the macroeconomic backdrop, the U.S. economy is improving. Growth is not as robust as we would like it to be, but if we look at various indicators of consumer confidence, whether that's the employment situation or the housing market or the consumer confidence numbers, everything's seeming to improve. If we look at the the commercial side of the economy, industrial production and capacity utilization, various commercial indicators, they're all starting to improve. When you're in an expansionary economic environment, generally speaking, small cap companies outperform large cap companies because they derive a greater portion of their business from the domestic economy. So as we're in this expansionary economic environment, we think that bodes well for smaller companies. So too, we're on pace for interest rates to increase. At some point, and we don't know if that's going to be next month, but at some point we would expect interest rates to rise, and generally speaking that bodes well for small caps as compared to large caps because history has shown that more times than not small caps outperform large caps in a rising rate environment. And the last thing I would say in terms of the macroeconomic environment is the strength of the US dollar. What we've seen over the past 9 to 12 months is that a stronger US dollar has been a big headwind to large cap companies with a significant portion of their business overseas. That's less of an issue for smaller companies given that they're more domestically focused on the US economy. They're not as hurt by the strength of the US dollar. So that's how we look at it from a macroeconomic perspective. From a corporate fundamentals perspective, sales and earnings growth for these smaller companies continues to be robust. There is opportunities for margin expansion, and the balance sheets are quite strong. The companies have a lot of cash on their balance sheets, and they're putting that to work by either investing back into the businesses, returning some to shareholders in the form of dividends and buybacks, or acquiring other companies. The M&A market's really heating up in the small cap asset class, and that generally bodes well for the asset class. So that's the fundamentals from the corporate side, and then I take it to valuation. Valuations have come in as the market's pulled back a bit this year, and you're looking at paying a mid-teens forward PE multiple for small cap companies, and we think that that's actually pretty attractive relative to the growth we expect, relative to the strength of the business models, and as compared to large cap companies.
Okay, generally speaking, what's the returns compared between the large cap and the small cap?
Well, generally speaking, the returns on a stock basis have been roughly equivalent, this year. If we look back over the past couple of years, small cap returns have actually trailed large cap returns. So we think, considering that they've trailed large cap returns over the past couple of years, but over the much longer term, small caps have generally outperformed large caps. We think coupled with the attractive valuations that we might be in store for some small cap outperformance as we look forward.
For the Fed fund rate, as you stated earlier, would it affect any small company or large company more?
Well, generally speaking, it doesn't really, we don't build a lot of interest rate sensitivity into our portfolio. Right. So other than, if interest rates rise, what we say for the right reasons, the right reasons being that the job market is continuing to improve, inflation is near target, and generally the economy is growing. I think that bodes well for all U.S. companies, because if the Fed's raising rate because they think the economy is on the right track and they think global growth is supportive, I think that bodes well for all U.S. companies. History has shown, if you look back over past Fed tightening cycles, that small caps have generally outperformed large caps as interest rates have gone up. And why is that? One, because they're more domestically focused. Right. And two, because some of those, in a low rate environment, generally speaking, higher dividend yielding large cap companies are seen as a safe haven by some investors, and as interest rates rise, they lose their mystique, they lose their luster. So, sometimes people shift into smaller companies. So that's also, argues for outperformance of small caps. All right. So somewhat 40 companies, you said? About 46 right now. 46 companies. We generally try to keep it between 40 and 60.
In which sectors are they?
Across sectors, consistent with the Aberdeen process across all portfolios across the globe. We don't manage to benchmark industry weightings. We're really building the portfolio from a bottoms-up view of the individual companies and trying to find 40 to 60 of the best companies we can that are trading at reasonable valuation multiples, regardless of the sectors that they operate, of the industries that they operate in. We're looking for 40 to 60 of the best companies, and we really don't care that much which industries they operate in. Now, with that said, we do have general parameters around which we will manage that. We won't stray more than 10% from any benchmark industry weighting, but the 46 names in the portfolio right now go across industries. It
varies from financial sectors, from real sectors,
health. Financials. Our largest weights are consumer staples, industrials and materials, and our biggest underweights would be healthcare and financials. Healthcare being because a large portion of the healthcare benchmark are biotech companies, and small cap biotech companies generally come with some quality concerns that make them uninvestable for us. They're generally developing one drug, and it's either the drug is going to make it or it's not, and the stock performance is going to be largely driven by the development of that drug. And they're usually outspending their cash flows and things like that, so they would take them off our radar screen right off the bat. And financials were underweight, given a large portion of the financial index is made up of real estate investment trusts. We do own 2 REITs, but generally speaking, it's a business model that's a little bit tougher for us to get comfortable with, given the high leverage in the models. In terms of our overweights, we're overweight consumer staples. That's an area we like, given the stability of the business model and given we can have confidence in modeling out those cash flows. And we're also overweight materials. I think a lot of investors see that we're overweight materials and think we're making some type of cyclical bet or have a lot of commodity price sensitivity, but when you really dig down into the holdings that we have in that sector, it's a lot of value-added, higher return on invested capital type business models. Right.
Is there any risk that we have to beware of?
Well, there's always risk. I mean, we have a labor-intensive bottoms-up research process, but no investment manager is immune to making mistakes when picking investments. The key for us is that we closely monitor the holdings on a daily and a quarterly basis, and if there is something going wrong fundamentally with the company, we get on top of it. We talk to the management team as soon as we can, and we try to get to the bottom
to the master fund?
To the master fund, and try to get to the bottom of what's going on. But larger risks to the fund, I mean, would be no different than risks to investing in any other small cap fund out there. Generally speaking, if you're heading into a recession or in the midst of a recession, small caps have underperformed in those types of environments, given that there's more leverage to the domestic economy. So I think that is one risk. And generally speaking, if you were to compare small caps to other asset classes over time, they are a bit more volatile. But if you have a longer term time horizon, you usually have been rewarded for that longer term time horizon in outperformance over the longer term.
And next week you're still going to be here with us to talk further about investing in US.
Absolutely.
Right นะครับในส่วนของสัปดาห์หน้านะครับคุณทีมยังอยู่กับเรานะครับที่จะพูดคุยถึงในเรื่องของการลงทุนในอเมริการวมถึงนะฮะการลงทุนกับกองทุนเปิด Aberdeen American Growth นะครับ Smaller Companies Fund เนี่ยนะครับก็น่าสนใจทีเดียวนะฮะสามารถติดต่อสอบถามได้ที่ทางด้านของบลจ. Aberdeen ซึ่งเปิดขายกันแล้วนะครับสำหรับสัปดาห์นี้หมดเวลาแล้วนะครับของรายการรวยหุ้นนะครับคุณจิมผมและทีมงานลาไปก่อนนะครับสวัสดีครับ